All right. Well, welcome everyone to this month's webinar. A very, very exciting one. It's been a couple months. A lot of great things going on with advisors and the markets and our industry. So today's going to be all about setting up your portfolios, revamping, getting ready for all the industry changes. But boy, Drew, in the last couple of months since we had one of these, boy, a lot has changed. We have some nice a little bull run in the markets here. So let's start off with what the heck's going on in the markets. And Drew, let's get some insights on what you're doing right now and what you're saying with clients right now.
Well, John, thank you. It's good to be back with everyone here on D2 Radio. It has been an exciting 2 months. We've had a lot of buildup and consternation regarding the potential Brexit vote. Now that the vote has kind of come to reality, we had a big, leg down, and now that's come back with a pretty steady stream, not every day, but a pretty good uptrend here in most of the indexes. And, it's not every day, but occasionally we're hitting new highs here on the indexes. I think we have a pretty good feed of both corporate earnings and other geopolitical news that has fed a lot of this. It's not crazy to get multiple calls per day or multiple meetings with clients to have them ask their advisor what's their take on the election. There's probably a lot of concerns there. And then there's probably a lot of concerns, too, about interest rates. The Fed data that came out today, it seems like now we're getting close to half. The Fed is ready to raise rates and begin that normalizing pattern. So one of the things I've noticed, John, is really people are forgetting pretty quickly that the start of this year was the worst start ever for stocks, and generally speaking, what we've seen is a pretty significant rebound in aggregate from the lows of around February 10th or 11th. So that's good. Also within the equity space, I think what we've seen is a pretty good sector rotation. The year started off with pretty good performance out of telecoms and utilities only. Then we had lots of strength in energy companies when it became clear that they all would not capitulate and go out of business. As that rally got a bit long in the tooth, you saw money move into technology now over the summer. Apple's had a pretty stunning move from $92 to the 109 range, so to speak. And we've been noticing in the investments that we work with pretty sizable gains across the board, with a lot of portfolios now already into mid-teen type year-to-date report numbers. Also in the commodity space, silver's had a Comstock low type year. Gold's done pretty well also. So, we're seeing a lot of things happen. In the near term, the thing that's gone on I really can't explain is if you follow any coal producers, really since July, several of them are up 50%. That's obviously contrary to what you read on the news tape every day based on what the election cycle says, but definitely there's lots of exciting things going on. I think, the questions that I hear from clients on a consistent basis is how long can this last? We're due for a correction. What are we going to do if insert the candidate's name wins? So I think as financial advisors, we need to be ready, have people positioned to know what they need to be doing for their financial plan, for their personal economy, and not necessarily worried about some of these big exogenous events that might happen throughout the world. The market has shown a tremendous track record of being able to be affected for a day or two or a few weeks about events, but then ultimately shrugging that off. one of the things, John, that, a lot of the material that we get has kind of, I would say, it's kind of gone off the front page is a fear of recession. We'll have a couple clients bring it up, but generally speaking, where we are now, I think with a little bit better data coming out about the economy, that fear of recession has subsided. I think one thing, though, to talk to clients about now has to do with inflation. And I think because inflation is a story that's been a little bit forgotten because the federal government has told us now for about 7 or 8 years we really don't have any inflation, that inflation is 1%, maybe less. But John, I would challenge all the advisors on this call, talk to your clients. Any big ticket items that they've bought, let's say remodel a house, buy a car, send a kid to college, pay a pretty good sized medical bill, any of that stuff, if you went and looked the last time you had to do it or back 2 or 3 years, I think what you would see, John, is probably inflation more to the tune of 5 to 7%. So that doesn't jive with the consistent government drumbeat that our inflation is 1% or less. So therefore, I'll talk to my clients about that. That type of story really resonates with clients, and we've been moving more of our fixed income money into inflation protected devices because the time when you want to buy inflation is when there doesn't appear to be any inflation out there. And so that's the old, buy low, sell high type stuff that, we continue to do with our clients. And generally speaking, that's exactly, what we've got with our clients. Now, one of the things I've pulled up here, John, I think everybody can see this is the S&P 500, kind of going back a 12-month chart. We're back above our highs. To me, this is a chart that, it's a good-looking chart. It doesn't appear to me to have any, Yeti or abominable snowman or, Sasquatch lurking around the corner. But eventually we will have a pretty good-sized pullback. And if you look at this giant W here in the middle, this is the pullback we had to start the year, and so we've had a pretty good climb out of that market. And then you see this is the Brexit over here kind of more towards the end of June, and then we move up and out like we have. My supposition is probably the next real bump in the road will be when interest rates start going up. I think people will freak out and think, oh my God, rates are going up, what are we going to do? And probably that might last a few days, it might last a few weeks, but I would say in the long term, that's probably a pretty good indicator to buy. Looking at kind of where the trends have been, let's put in the utility index just to kind of reinforce my point. You can see, utilities are kind of been on a slide here since coming out of the 4th of July weekend. That's a drop of 52 to, 50. That's probably about a 5%, 6% drop compared to the BGT, which is the tech index. You see a little bit more of a consistent run up from that standpoint. So there's definitely been a change in leadership, which I think, John, is healthy for the stock market. It's not just the same things going up week after week, month after month. It's been a rotation. So that's something else you can tell your clients about. And that's obviously what we're telling ours is I know the market's making new highs, but inside this thing we call the stock market or in your investments, we're really seeing leadership being passed off from one to another. The forgotten man, the sick man of Europe of this year has been developed market equities. those have been, if you've had any large weighting to some international positions, those have done terrible in comparison. Emerging markets are through the roof, and where it was horrible last year, it's great this year, Russia, Brazil, et cetera. I would be more into profit-taking mode there than saying, we're up 30%, it might be up 60% in Russia. I don't know. I'm not saying it can't happen, but I would be looking at your emerging market exposures and see where you can kind of reel in some profits. As far as what we read, John, here, we've got a great subscription with Bank Credit Analyst. With regards to the election and potential winners and losers, right now they kind of see it this way. A Trump win, they think, you're going to want to be more allocated to companies that do business in the U.S. because they think what you're going to see is tremendous dollar strength. And the allegory behind that is a Trump win will probably scare a lot of non-registered workers back to where they came, and those workers typically take the entry-level rung on the ladder, and those wages for those type of employees will be much, much higher because the supply of the labor force will be much less. Those workers spend more of their paychecks, save less, which is inflationary, and that will scare the Fed, and you'll see rates maybe move up a little bit faster than what they thought, which, given the global interest rate environment of negative rates in a lot of places, will make the dollar a lot stronger currency versus, the euro, the Japanese yen, the British pound, et cetera. So we have a plan if Trump wins. The Hillary victory would probably be more of the same for globalization. So, you would probably look at the dollar may get stronger, but maybe not as much as if Trump would win, but look at multinationals. And I think what we would look at is investigate those places in Europe, those companies that maybe do a fair amount of business in the U.S. or globally, but I think probably your more multinational trade will come in with Hillary wins. The area that I probably have the most greatest concern about, because I think there is without a doubt the most uncertainty, John, is around healthcare. And those issues tend to be, no one really knows what Trump's plan is, and he has consistently said he likes a single-payer system, not that he would put it here in the U.S., but he has an affinity for it from his businesses elsewhere, versus the Obamacare system as it is. I don't know, John, how long that can go on without major tweaks, which would create more uncertainty. So, with that, I think, that's kind of how we are sizing up the election. My personal opinion is I would expect more kind of craziness to come out in the news cycle. I'm certain other places and other actors have emails from certain people, and we'll probably get more details about those in an effort to try to influence the election one way or the other. But with that said, I think if Hillary can widen her lead out to double digits by the time we get to early October, that's going to be a pretty tough mountain for Trump to climb over the last 4 or 5 weeks heading into the vote. But we'll just have to kind of see what happens. So that's kind of a background of where we are, where we've been over the summer. I think the area that still is yet to really rally and make a big push, I would say, John, would be financials. They've done a little bit better here recently, but still, are negative since December. Probably just break even year to date. And a lot of that just has to do with interest rates. We'll see what happens to rates but financials are kind of the last leg. Me personally, I think once financials start rallying, it might be time to kind of batten down the hatches and see if you get better value after maybe a little bit of selling coming on. So that's kind of a little bit of what my takeaways are as of August 17th.
So we will have, the timing's nice, we'll have a couple more of these leading up to the election. We'll have one very soon after, and then even another one after that before the end of the year. So this is really insightful just to hear how you're thinking, what's going on, what you're saying to clients. And we even got a glimpse into as well some strategic moves that you're looking to make in portfolios now, like the inflation products, positioning there, getting ahead of the wave and not waiting until that wave comes. I think it's great. So that's the kind of stuff we want to dig in and extract here. So why don't we go to the next level and even look into the investment spreadsheet that Drew uses and look at some specifics of what changes are coming. So I guess, Drew, last time we did this was in January, beginning of the year. We got a glimpse inside what you were doing, what specific products, mixes, all the things you were using there. So what would you say in the last, 8 months that we did this last? What would you say have been some of the biggest changes in your lineup?
Well, I think we've added more inflation protection. I think in some of the S&P and IRG models, you've seen technology added. You've seen some international stock deleted. I think that's probably some of the bigger changes. I think, too, where the market is, it's more of a stock picker's market. I noticed S&P, they jettisoned, I think, General Motors and kept Ford in some of their portfolios, or vice versa. I can't remember. I can scroll down here and tell you. Looks like they got rid of both of them finally, thank God. No, they kept Ford, got rid of G. The other thing is you've seen oil prices go up modestly, and since we talked, oil went from wherever it was in January down to around $26 a barrel. Just cracked 50. We're back now, I think today, $46 range. Let me tell you where we are. But you've seen Chevron go from, John call it, this is by memory here, $75 to 108. Now back to around 110. Yeah, crude's at 47.57 today. You've had let's see, Chevron, $69 to 107. Now at 102. You've had Exxon go from 66 back to 95, and it's about 88. So one, what that tells me is, there's a reason why most portfolio models have you have cash for opportunities like that. I don't know that anyone in 08 that would have bought Johnson & Johnson, Exxon, and Chevron, throw in a couple other, blue chip stocks, wouldn't come out ahead. But what I've noticed is most of the oil fear really appears to be overplayed. And so in reaction to that, you've seen a lot of people totally kick the baby out with the bathwater as far as getting out of energy, and they've missed those types of run-ups. 66 to 95, that's a 50% return on what was one time the second biggest stock on earth. That's amazing. That's like, Apple going to 170 in 3 months. People couldn't believe it. So one, you asked what are the changes. So, changes just, it's not really a change, but it's kind of a drumbeat. Keep buying quality until those companies tell you they don't know how to behave. The other thing I would say is we really need to be watching over diversification. Both Grant's Interest Rate Observer, which we have a subscription to, and the bank credit analyst people. And this is something you're never going to get out of Fidelity wholesaler or, whoever you get wholesale stuff from, is academically now there's really people talking about over-diversification. And maybe part of the reason why people don't get the returns that, say, the stock market gets, quote unquote, is they're over-diversified. And if you look at some of those products that are available, John, that are kind of, have a built-in portfolio and all that, at their performance versus other types of things, I mean, you see like, wow, how can investment A make 2%, investment B make 8%? Part of it has to do with we may be in a world of a little bit over diversification. And then the biggest thing we've done really in the last 12 months is on the fixed income side, I'll keep talking about bonds, is really get credit quality better. And because I think the bonds are in the portfolio to do something different than stocks do. And a lot of the bond funds that are out there, you're kind of buying the same thing at a lower credit quality product. So when stocks go down, they go down, and the performance is really tied to stocks. So A, watch the credit quality. B, just keep buying quality stocks on the stock side. And then, watch what you use on alternatives. REITs have had an unbelievably great run this year. And I think, that's something that's been kind of missed in the shadows. And I will tell you, there's some non-publicly traded REITs, John, that have done great. So, those are kind of my four main things. If you said, what have you been thinking about, what have you been doing differently? I would say that those would be the biggest. On the screen now, these are the updated S&P models. Total return has had an unbelievably good year. High quality capital appreciation, not so much so. They kind of hit a headwind. A.O. Smith's one of our favorites. That's in that portfolio. It's just ripped the cover off the ball. Get over here to the mutual fund tab, John. Kind of run down these real quickly. You can kind of see on the global bond fund, we've been using more of the Dreyfus, than the Oppenheimer. It's a little bit better credit quality. It's up, 4.5% for the year. Deutsche Bank Ultra Short, we've used that. MFS, a couple of those products. Tax exempts have had a great run. And some of the total return funds have as well. We've probably been using more of the Western Asset and Fidelity as opposed to the other. Hang on here, scrolling down. High yield munis have done awesome, except for the J.P. Morgan. That Oppenheimer Rochester with Puerto Rico not totally imploding, that's done pretty well. On the funds, we've been, really kind of watching that Columbia has some pretty good large cap funds. You don't see them here. They've just kind of struggled this year. I think you live by the FANG, die by the FANG type thing, and that's the Facebook, Amazon, Netflix, Google trade. You got to have a little bit different approach. Love the equal weights. John, as you know, most of the large cap, if we're going to index it, we do equal weighting. One of the things we've kind of got in the hopper is the dividend aristocrats. You're not going to see it on here, but that's one we've been really looking at to see, what do we put in to make things a little bit better. Down on international stocks, that Oppenheimer Developing Markets has done awesome. That's a stalwart in our 401k plans. Virtus Greater European Fund, that's more of your staples companies headquartered in Europe. It's modestly up, which actually versus the index is not bad at all. We will kind of go down here. Alternatives, that Dreyfus product's done really well. If you stuck with the MLP funds, they've been a home run as well this year, big double-digit returns. Convertible bonds have done well. We don't have any thing. Yeah, you can see the Global Infrastructure Fund for Deutsche Bank and the Goldman MLPs, 15 and 12.7 respectively, but they've got a big hole to kind of dig their way out of. So the ETF portfolio, you know, what you see there is the taxable munis right in the middle of the municipal national intermediates. I mean, 20% returns, 18% runs. They have had big time performance. The international bond thing from Vanguard, you know, almost 7% performance. You see in the commodity space, that's where a lot of the losses are as well. And let's see, scroll down. Let's see what else. The you know, as we get down here to the sectors, you can see the global financials and healthcare have been decimated this year, comparatively speaking. Energy has had a very nice way to go. Utilities are up almost 12%. You know, the emerging market index is up about 18.5. So, you know, we've had a pretty good run just about everything but the European stocks. And I think that's kind of the way most people have seen things. Biotech, John, would be one of those things. I said healthcare scares me. We're kind of lightening up there. Eventually, depending on what the news is, that's probably, you know, if the news is anything but the worst case, that's probably a buying opportunity, you know, to tell the truth. Let's go to the next page. 50,000 or less.
Hey, one quick thing, dude, before we get into the segments of portfolios here. Tell us, a lot of advisors ask about the stock portfolios. And I think we got a combination of people that consider and thinking about using an entire one. I see a lot more people trying to pick pieces off from these. So tell us about, I mean, what are you doing here with these? Are you mixing, matching? Do you ever pull off maybe the top 5 rated in these portfolios? How are some other ways advisors could use all the research that we get from Ameriprise?
Well, I mean, you can use it any way you want to. I do think it's better to use the portfolio as an aggregate than to kind of go in and say, well, I'm going to pick these off of it. So that's one. But yes, I totally, it's understandable to go in and try to pick what you like about it. I have gotten so much angst from CPAs. What we try to do is drop the pass-throughs on our non-qualified stuff. I will say that. So, you know, if it comes in a portfolio, we'll probably pass on that. You know, you can see on some of these, we've added a few that aren't necessarily on the portfolios, but for different reasons, we kind of had them in there. You know, and we're out of, like, now Kroger and Stericycle to name two that I look at on this sheet. But I try to use it as a total portfolio as opposed to pick individual stocks. And one of the things we were talking about, John, and prepping for this week, is kind of one of the things I wanted to talk about today is using a brokerage account. I mean, because if you know, have somebody that wants individual stocks, you know, maybe you use most of this S&P total return strategy, and even if they've got, you know, $30,000 or $50,000, you know, really what you could get into here is probably, you know, maybe $3,000 or $4,000 a stock, charge them 1.25% commission. You've got a pretty good strategy that maybe give it 3 years, you probably may make as much as you'd make in an SPS account. And so that's one of the things that we discussed, certainly. So you know, these stocks have been vetted by either S&P or IRG, the ones in these portfolios. So you can pull some out, but also, you know, if you're going to do that, I think at a minimum you're going to want to have probably 5 stocks, you know, 5 or 6 at a minimum And if you're going to have 6, why not have 10? I mean, so I would try to more use the whole thing and sell it as a strategy as opposed to like just picking stocks. Does that make sense?
Excellent insight, sir. That was really good. So I think the next step here is how do you put all this together? I like to think of Drew's spreadsheet and lineup as a team. When you think about a sports team, there's lots of players on the team, but only some of them are the ones playing at a time. So basketball, football, baseball. Some people are on the field playing, some are not. So you could think about this as this is Drew's deep bench of players, and he's selecting which ones he's going to play with at different levels. And you'll see as we go up, we start at 50,000 or less to smaller accounts. We go all the way up to the $500,000 plus. You'll see the amount of players in the field will kind of increase as we go up. So Drew, let's go the progression here from, I like starting at the top, $500,000. We should always think about our services for our biggest, best clients. So how are you putting together a portfolio? You get a new client that has $1 million, they come in the door. How are you piecing all these different pieces of the puzzle together for them?
Well, this is kind of more of our non-individual security portfolio. If they're okay using individual securities, John, for, equities, we're going to have individual securities in there, and where we can, individual fixed income pieces. But basically, I kind of go back and you say, how do I piece it together? What's their risk tolerance? And then how soon are they going to need income? The main thrust of where we'll start is that 4-3-2-1 approach, with, about 40% in equities, 30% fixed, 10% alternatives, and 10% non-correlated. And then I'll either get more aggressive from there or more conservative from there. So if clients are okay using individual securities or say, Drew, you do it, I'll go after that, and that's what I'll use. If they say, well, I'm more comfortable with funds or indexes, then we'll kind of use more of this approach and use more of what we're seeing on those investment spreadsheets. But I think the trick is, especially in the alternative space, get something that is going to be an alternative to stocks or bonds, and then in the non-correlated space, really, really, really do your homework to find something that's performance-wise is going to try to more zig when everything else zags. In this day and age, it's not, I count that as cash too. I mean, so it's not a disaster to have some cash sitting on the sidelines, and I found that conversation with clients to be very readily absorbed because they see what goes on in the world today, and they're like, yeah, if we need to have cash, that's great. Let's keep some money in cash. As you move down the ladder, we'll use less individual stocks, and then at that point, probably in something this size, have more ETFs or funds. There again, our preference on the large cap space is to go equal weighted. One thing we don't have in here yet is that Dividend Aristocrats product, but that's another equal weight product. What I continue to see in funds, I mean, and if you do, Chad's in here today with us. He's a longtime D2 teammate, and he's coming over to, our place now, is that a lot of the better performing funds in different asset classes have fewer holdings. And I don't know if you've ever noticed that, John, but a lot of times, people that are high conviction investors, when they're going to do better than just buying, say, the equal weight. But you need to kind of offset maybe your position in equal weight with somebody that's more high conviction. So essentially, that's kind of another reason why I like having all the stocks in the portfolio, because in a lot of ways you're replicating a high conviction mutual fund, that may have 20 positions or 40 positions, So I think you give yourself more flexibility than those fund managers do, but inherently you've got your own deal, and that's kind of what we look at.
So I think I love getting the curtain pulled back and seeing all the details here of what Drew does, how he puts it all together. So as you go down the line, for you, Drew, where do you kind of draw the line in the sand where you're doing individual securities, where you're even doing SPS or SPS advisor at all? You've got some different breakpoints in your spreadsheet, but when do you kind of really back down what you're doing for clients as you get to these middle and lower tiers?
Well, I think we try to do SPS advisor as much as possible because we've got it down to a science here. And so when we can, if they've got 100,000 minimum, we're going to make it work. And our bare minimum there is a $25,000 account where we can kind of shrink some of the stuff we do for that. And that's going to be, John, that's going to be all ETFs. You're going to have to be, for individual securities, pretty much to 200 grand to make it work and make it worthwhile. If you're going to have a model that's going to have, 15 to 20 some odd positions. So that's kind of the cutoff. Now, below that, we're going to use ETFs, some funds in different mixes to kind of get those portfolios. One of the things, too, I think that I like, I'm an equal weight guy. We, look at what's available with different sectors. IRG, for everybody, we've kind of said for years, get on that subscription list to get the, before the bell emails that IRG sends out. Let's see, it's called Morning Research Notes. That's what it's called. Basically, they've been doing a sector map on there. Have you noticed that, John? It's color-coded.
Yes. Yeah.
Looks like a weather map if you lived in Brazil, I guess. But look at that, and we've got a little investment solution that's all ETFs geared around the sectors, and I think year to date it's up about just under 10%. So there again, you can even at less than 100,000 with some ETFs build a pretty good investment ideas on either Advisor or SPS Advantage. I think some of the things that what I've noticed too, in looking obviously, and we're going to do a breakout on this, I think, in Charlotte about the ADP and some of the variable annuity portfolios, is I think probably what you've got there is maybe being a victim of over-diversification. So I think, it's clear right now the U.S. is kind of the top economy on earth, and most of our portfolios, as you could kind of see by the allocation, have been heavy that way. And I'll go back to kind of the 50,000 or less, I think, where Grant kind of put in the weightings there. We've got Sweden at 1%. Everything else is domestic. So with that said, I think there's some opportunities to really be able to design something specific for your client. So obviously, I'm a fan of SPS Advisor. I'm a fan of SPS. We still use a few separately managed accounts, but there again, you're going to be really north of the $1 million mark is when I start thinking about those as solutions as well.
So I think a lot of this resonates to those of you that were at the D2 Think Tank out in Indianapolis. For a lot of you that have been in coach consulting calls here, I think building out your offering, the value, the total fee experience you provide to clients, this is the real root of it. So you heard Drew say in SPS Advisors using mostly ETFs. You heard how he's using Ameriprese's research on the sectors. It's doing pretty good to bring something new and different. And I think that's the whole key here, is we really take a lot of the learning from what Drew does. I think one of the top practices in the country on the investment platform. I think there's a lot that we can learn and translate at any level, whether you've got multiple traders like Drew does, or you're smaller practice, I think the takeaways here are pretty clear. Drew's creating a lot of value for his clients, and there's a lot of value for what he charges. And to me, as you look at what's changing with the Department of Labor going forward, to me, it boils down to two things. One, it's transparency, people knowing exactly what they're paying for. And secondly, price versus value, which is something we've talked about for a long, long time, many, many years here at D2. The value you provide yields a certain price. When there's value in play, most people don't ever question the price. Price, in fact, becomes irrelevant. But when people are questioning your fees, your price, they're actually questioning the value that you provide. And so here, you've got a really good example of how Drew's creating some different value in different ways. So I think for each of you as an individual, pulling out and extracting from this, what value can you create your people, your clients? How can you enhance what you're doing with them? Can you take some of this basic free information that we're getting from Ameriprise? I mean, it's free in one extent. Another way to look at it is you're paying for it with all your franchise fees, haircuts, global admin fees. You're paying for all this research, and might as well take advantage of it and use it. So it's there. You have it, and building something like a little sector rotation portfolio, using some of the existing portfolios they have. They even pick out ETFs and things for you on here, which can continue to drive down the client's total fee experience, is in alignment with the transparency that we need to be providing, and it's also in alignment with bringing more value. One thing that we've heard Ameriprise talk about a lot is this value concept and making sure that you are delivering value in your managed accounts. It's you're just following a basic IRG model, and there's nothing additional, anything else that's not the standard model. If you're running an ordinary system like that, it does sound a lot like a robo-advisor platform. And it's pretty hard to justify your high SPS fee compared to that very low robo-advisor fee if there's nothing extra in there. So if you have an ordinary portfolio, think about how can you make it extraordinary? How can it be special for your clients? How can you add some extra special things? Whether it's some of the things you can copy from Drew, some of the things from the Ameriprise research. I think that's really the big learning here. And as we go into next year and the year after, the new world with some of the new Department of Labor recommendations, that's really what we got to be thinking about. How can we make things more transparent, drive down the internal investment costs of people where they don't see all these costs? How can we keep those low, keep everything out front where they can see it? How can we create more value, do more interesting things for them to certainly more than justify the price that they pay? So, Drew, I mean, you've got a lot of different examples of how to create more value and add new things to portfolios. I mean, for advisors out there, what would you say are some good starting points? If you were a regular D2 advisor, what's maybe a couple of easy strategies that they could use to kind of enhance what they're doing for the bulk of their clients?
I would look at that sector map on the IRG every day. I would look at on S&P research on your Thompson, the portfolios they have. We've listed too the total return and the high quality capital growth. Those are, obviously, real easy things to emulate and to follow. I think, John, that's where I would start. The other thing I think that gets lost in the shuffle, but what we work with enough advisors in their own practices, not just here in Owensboro, but nationally. Clients like the idea that they have something tangible they can see you're doing something. So I always start a relationship to send out the confirmations. And, if you're charging somebody 1.5%, 2% on an account, and they're getting papered every month on changes you're making, they know you're working. If you're charging somebody 1.5% or 2% for a model, and they never see any changes come through the pike, that's when it kind of starts creeping up. Hey, what's this guy doing for the fee? I never, even though there could be things going on, if the client doesn't see it, it doesn't happen in their mind.
Great.
Yeah, and I think as that, when you do that, you do those things, you really separate yourself from everybody else, but you're insulating your practice at the whole time. They can see what you're doing. Unlike laws and sausage being made, you want people to see how portfolios are made, because they can see, why am I paying you $10,000 a year to do this? Well, there's been 85 trades done on $1 million. Oh, okay. So, unless they're going to get down to the granular ridiculousness with you, you're going to show what your value is. So, what we try to, so think of that. Look at something that you can handle for your office, but I would start with the S&P tools, and then look at that sector deal that's on the IRG in the mornings, and don't reach out, call your clients, do what you should, and let them know that you're working. That's what I would let you know.
That is a great insight. And, for anyone out there that's not on SPS Advisor, starting in January, there are no more ticket charges. And I think it's going to be interesting to see when the reins are off. There's really, with ticket charges, there's a disincentive to trade because it costs the franchise owner money to make changes and do things for the client. I think with those out of the way, as Drew's finding it, SPS Advisor, with the reins off, those training wheels off, I think that's a great suggestion. Is doing more, trading more often is a great way to show value. Now, Drew, interesting question there. Do you ever go back and help someone understand and interpret or quantify that value? That if you got 85 trades on $1 million and you were with maybe a wirehouse firm, do you ever go back and discuss what kind of commissions they would have been paying at another firm compared to their package asset management fee with you?
Absolutely, and I think a great time to do that. We do that once a year. We rebalance everybody's portfolio, and I'll say, okay, year to date you've had 60 trades. We're on June 30th. It projects to 120. Here's what it would have cost you. If you were down the street at $125 a trade, I mean, you'd be out $7,500 or whatever it ends up being, not counting the fact that you would probably be paying for something you don't know you're paying for. So I will also take time to point out where we've gotten off the elevator at the right time. And so with individual securities, that's easier to do. We sold you out of Stericycle at 107. It's $81 today. And I'll tell people I'm doing this because these are the things that we never get thanked for. And I'm not trying to be immodest. At the risk of being immodest, is this, I know we're doing our job, but this is something most clients would miss. So
yeah, I think that's pretty huge. Just going back and quantifying it. I mean, it's just comparing. Hey, if you were down the street, if you were somewhere else, this is what you would have paid to get the same thing. That's really important because we talk about value interpretation a lot. It's a difficult thing because I think what happens sometimes for advisors, we're in our world. Sometimes we know the value, but sometimes customers don't understand the value. And the one who's paying, the value needs to be crystal clear from their perspective. And I think that's a big gap sometimes for advisors. So you hear how Drew's masterful at it, going back and uncovering, hey, we did all this stuff for you, and we're only partway through the year. And if you were somewhere else, this is what you would have to pay, a lot more to have this stuff. So instantly, whatever they were thinking about the relationship with Drew, all of a sudden it's pretty darn good because Drew's doing a lot for them for one low price. And that is a classic value interpretation. And we need to do that in almost every single interaction with clients because they will forget. They will forget your value. Sometimes they may get a CPA or somebody barking at them about why you pay a lot of fees over here. It seems like it's more. Or, hey, I hear my friend plays less over at Schwab. We have to be very diligent and very upfront with our value, our price, the total fee experience. All these things need to be almost every interaction, because that small little value interpretation that Drew just brought to life there is huge. And that's the difference in an ordinary and an extraordinary portfolio. So I think here, depending on the scale of your practice, continue to reinvent, continue to extract new things from these webinars, continue to take and borrow things from Drew and make them your own. Doing a simple sector rotation. Hey, even if you only did it for your top 10 clients, that's pretty valuable to them. And those are the people that create most of the revenue. Starting small with some of these things could be great. The stock portfolios are available. I think, Drew, the S&P ones are on Thompson, and then the Ameriprise ones come from the IRG site. Is that correct?
Yeah, that's correct. And John, we got a question here out of the Steel City. Eddie Poach, he's been with the Pittsburgh Steelers a long time, playing middle linebacker. He says there's so many fee and commission models around the industry. Do you find that sometimes opening Pandora's box about fees elsewhere can be difficult? It can be. I think it's how you approach it. Eddie, I think, the way I approach it is like the old Prego commercials. Remember the old Prego line was, it's in there. Is the garlic there? It's in there. Is the tomatoes there? It's in there. The way I approach it with clients is, if you're working with somebody and they're telling you there's no fees, it's like the old Prego commercial. It's in there. Nobody's doing this for free. John can probably tell you, offline, Eddie, how to, use personalfund.com to show clients that, and then show them what as Travis refers to it, I think, as the total fee experience, where they are at Ameriprise and what they're getting is night and day, miles ahead of what they're getting anywhere else. That's how typically I've done that.
Good question there, Ed. If there's other questions, we kind of approach the end at the top of the hour here. Go ahead and post. You send them direct to me or to Drew or to the dynamic direction ones up at the top there. But this is, I think this is the nuts and bolts of how to bring more value here as we enhance our offering to people. And, this is a great time here to do it. There's a lot of administrative things coming up here with positive consent forms for those of you that are at Ameriprise. A lot of opportunities to discuss fees with clients, to discuss price equals value. And if you're going to have that conversation, big topic at D2 Think Tank was using that total fee experience concept and discussing all of a client's fees and helping them understand all the different layers, peeling back the onion for them, finding ways to reduce that, reduce some of the middleman cost. And I find time and time again with advisors, clients would much rather pay you than pay a fund manager in a corner and window office. If you think about 12B1 fees, clients have been paying you all along under the table. They just didn't really know it. They would much rather continue to pay you than pay somebody else. So you've got to bring that to life. This total fee experience is really important, and our big opportunity is from now to the end of the year to really make some of these shifts, align your offering to be something that's not ordinary but extraordinary, and be in position to justify your value and be able to charge what you want to charge. I think I see a lot of people increasing what they're doing on asset management of what they're charging there. I see people increasing what they're doing on financial planning, what they're charging there, and continue to push up and enhance their value. So building this is a great part of building that value, pulling from here and finding ways you can deliver something that's extraordinary, not just ordinary. And then I think packaging this is kind of the next steps and working on your positioning. So I think as a follow-up here, try and find one or two new things for you to implement in your portfolios to enhance them in your sessions with your coach, Let's continue to talk about pricing. Let's continue to talk about positioning with the clients. And remember that the key to positioning is that value interpretation, making sure that the people that are the ones that are paying, that it's crystal clear to them, that they understand the value, and even take it to the next level where they could communicate that value to somebody else, maybe a potential referral. So, so Drew, as we wind things down here, going into rest of the year, any thoughts, insights on your portfolios, what you'll do with clients, any management things that you'll be looking for as we go into the back half of the year?
I look at inflation protection. I look for probably something zany to happen with this election. And John, I'm looking for ways to make America great again.
I love it. I love it. Well, thank you all for being on here. Be sure to email us any questions, any thoughts, and we look forward to seeing you in your coaching sessions. A couple great things coming up. We got the Private Wealth Advisor Conference coming up in October here up in Chicago. I believe that in a couple of weeks, in the next week or two, registration for that's going to be opening up. So D2 will be there. In fact, we're looking at hosting a little dinner outing the first night. Of course, we got D2 Live in North Carolina and my state coming up in November. So you'll be getting some stuff on that as well. So stay tuned for our D2 events, Ameriprise events. Stay tuned for our monthly webinars, crank it back up here. And we also got all new topics coming. We've got some new improved things based on some feedback from advisors, what you want to hear in these webinars. So very exciting new topics, new things coming up. So everyone stay bullish out there. We'll see you in your coaching sessions. And Drew, as always, thank you so much for being on.